On the 23rd of June, Britons will head to the polls to vote on whether or not they want to remain in the EU. There's much opinion out there on which way the vote will swing, and the world is anticipating which way this very close vote will go. Now, there's been uncertainty over the Brexit vote, and it's seen as one of the key risks facing the global economy at the moment. Joining me in studio now to discuss the implications for the Brexit vote and what this would mean for the JSE and the global markets, we have Lesiba Mothata, Chief Economist at Investment Solutions, and also we have Petri Redelinghuys. He's an independent trader. Gentlemen, thank you so much for your time. Lesiba, let me start with you. A few months ago, Brexit came up again, and it seemed as though from a South African perspective it wasn't really something to be worried about. That's the sense that I got. But now the concerns are growing. What's changed, and why should we be concerned about this?
Yeah, increasingly it looks like the opinion polls are polarized. You're getting people who wants to stay, and others who wants to leave, and markets don't like uncertainty, and it becomes problematic. For example, when the Economist intelligence unit says about 6% of GDP, UK GDP, would be shaved off if they were to leave the EU. And also the ramifications that could have for the bloc itself. You know, will Greece now find a good reason to leave? Will the united front of Europe decimate as a result of the UK deciding to not be part of it? It's just a very ominous sign when one European economy leaves, because it just leaves, it's very frail, as we appreciate. It's still a project. The European Union is still a project in that we have one central bank, and we still have very fragmented fiscal policy. And we have seen in 2011, when the European debt crisis emerged, that this is not completed. And it's not ideal to have a situation where it actually break up. It's not good for SA. Most of our exports end up there. It's not good for the globe. In fact, Yellen, in her speech last week, has highlighted this as one of the risks, along with what is happening in China. So it's not good to have a Chinese outcome which is slowing. And also now a Europe that slows, because that just leaves the whole world in a situation of weaker economic activity.
We're going to touch on that again, especially regarding Janet Yellen. Petri, I just spoke to Skalkalo around doing portfolio picks and putting together, a portfolio like a pro. And I know that you've been looking at some of the JSE listed stocks and looking at what the implications of a Brexit, or the ones that are most susceptible to any shocks regarding a Brexit vote. What can you tell us? So what should we be concerned about?
So I think we looked at three major stocks that are listed both in Johannesburg as well as in London, so the dual listed stocks. So I think I'll start with SAB, because it's probably the one that the most people own. So SAB is essentially listed both in London as well as in Johannesburg, and it's got an ADR in America as well. But we all know that there's this looming deal that's going to take place, the acquisition or the merger between AB InBev and SAB. So that currently is a takeout price of £42 per share, essentially. So what Brexit is doing is it is affecting the currency, which is affecting the rand value of the outcome of that deal. So just a couple of weeks ago, that was somewhere around 1,052 Rand a share. Now, however, that is 907 Rand a share or something like that, depending on what the currency does. I mean, I'm not sure where the currency is at the moment, but I know that the Rand has firmed up versus the pound quite considerably over the last 2 weeks. And I think a lot of that has to do with the fears of this potential breakup of the European Union and the looming Brexit and the impact that that's going to have on British GDP. As well as the property market, and there's many fears around that, which is putting a lot of pressure on the pound, and that of course is pushing down the SAB or the South African Brewery share price, because we're targeting £42 per share, and as the currency changes, that target keeps changing in rand terms. So that is one potential impact. Of course, if the deal doesn't go through, then we can expect that the pound should get relatively stronger versus most currencies, and in rand terms, SAB would then have to play catch-up once more. Another company that we looked at was British American Tobacco, both listed Johannesburg and England again. Good times people smoke, bad times people smoke, much like SAB. So even if GDP in the UK comes down quite considerably and times get really tough there for them, yeah, they'll probably keep smoking and probably smoke more than what they were because they're more stressed now. But again, you have that currency play which comes into effect. So we're again focusing more on the impact that it's going to have on the currencies than on the individual share. And then the last company we looked at was CCO, Capital and Counties, or Capco. Invested in properties, 3 major sort of properties in and around London. Very exciting properties. I think the share's done something 250% over the last couple of years. It's done really fantastically well. So far this year, it's performed really poorly. It's down 30% from its highs. As, of course, a number of things are happening, but notably pound weakness versus the rand most recently, and also a little bit of fears of the property sector in the UK overheating a little bit. So now, if Brexit goes through, one can imagine that the economic fallout would include property prices coming down quite sharply. So this could have an impact on capital accounts, in the fact that the net asset value of the underlying properties drops quite considerably. That plus now a continuing weakening pound could cause quite a bit of damage to that company. Again, on the converse, the upside risk here, let me put it that way, is that Brexit does not happen.
Let's look at that from, so we've looked at if it does happen, we look at those dual listed stocks. And Lesiba, let me bring you in here because you said, Janet Yellen has said this is a big risk factor that we are looking at the moment. So the possibility of it not going through, for me as a South African sitting here, this means what for me exactly?
Well, we export a lot to Europe. So if it stays together, it's a good thing, particularly if it stays together. We are now in a situation where we've gotten used to European GDP, which was 0.5% after the financial crisis. It's now forecast to go to 1.5%. Admittedly, that's still very low, but it's very good for an economy like South Africa, which needs actually global factors to align in order to have that growth come back from this recession that we're seeing. So we can avoid a Brazilian outcome. We do need a Europe that's stronger. We need a US that's stronger. We even need a softer lending in China so that we don't get affected, particularly on those commodities, because they've been battered so much. We do need a united Europe in that way, because it will help our economy in a big way, which is risking a deep recession if we don't get global factors aligned.
So on the 23rd, and I would like you to comment from the view of this, if this doesn't go through for stock markets, but on the 23rd, what's the consensus on the ground, or what we're likely to see?
Flip a coin, I think, at this stage. It depends on who you ask. I think most of the bookies, the betting houses at this stage, are betting on a Brexit. The odds of a Brexit taking place is slightly higher, which to me indicates that it probably won't happen. So I think that, from my perspective at least, I don't think it's going to happen. I think the risk is to the upside, in the sense that Brexit doesn't happen. We see the pound strengthening considerably, the rand take a bit of a pounding, no puns, and that all our dual listed shares recovering quite sharply off the back of that. That is, of course, just an opinion. I mean, I could be wrong. But I do think that we'll see it swing towards stay.
It's a 56% poll that says they're not leaving. It's real opinion polls. That's very close. But I think sense will prevail. It's not good for the UK to leave the European Union. 40% of service exports from the UK is towards internal Europe, within the European Union. The City of London remains a financial hub that is benefiting from this free trade and open movement of capital and labor in Europe, and I think it will be negatively impacted should a no vote arrive, which I think is very clear. I think sense will prevail, but I am concerned, however, on the pound, in that the net short positions in the futures market, from the Commitment of Traders report, it shows that it has increased. People are nervous, and they're shorting the GBP, which I think it's an ominous sign. It's a very it's a close call what could happen there. We prefer an outcome where Europe is united, because that's good for SA.
Gentlemen, thank you so much. To wrap it up, just to make sure we all understand, Brexit's not a good thing for South Africa. We do need to have the economies that will be able to support us. The stronger they are, the better it is it's going to be for us. And of course, those stocks that are dual listed and have exposure, they're the ones to also keep a close eye out on. Thank you so much. A very big thank you to Lesiba Mothata, Chief Economist at Investment Solutions, and also Independent Trader, Petri Redelinghuys.